Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 118 on June the 13th, 2020. I'm your host, Eric. And in this week's show, we will cover the trades from last week on Stitch Fix Inc., Occidental Petroleum, and Exxon Mobil Corporation. And we discuss three new trades on Plug Power, the Invesco QQQ Trust, and Bank of America. Now, it's always great to hear from listeners. If you have any questions about the trades presented here on the show, or even about your own positions, feel free to email me. You can email questions to eric@theweeklyoption.com. That's ERIC@theweeklyoption.com. I've also created a short video series to teach you all the basics of option trading that you'll need to understand to be able to follow along with me on this show. You can visit our website and click on the videos tab to watch them, or visit the YouTube channel for the Weekly Option. Now, this week in the equity markets, the U.S. equity market had its first pullback in 3 weeks. The Dow Jones Industrial Average fell 1,505 points this week, ending at 25,605 points, and the S&P 500 index lost 152 points, closing at 3,041 points on Friday. Now it's time for the topic of the week. The topic this week is going to be a return to the basics. We're going to discuss what happens to your options at expiration. And I get questions from people via email or even just other traders that I've worked with over time who just wanted to be clear on what happens at expiration. And since this upcoming Friday is going to be options expiration, I figured there was no better time to just go ahead and have the discussion. So all options for a particular month expire on the same day. So all June options that are monthly, not weekly options, all June options that expire on June the 19th will expire this upcoming Friday. Expiration is handled strike by strike. So each option strike will be determined to be either in the money or out of the money based on where the stock price is valued at the market close on the expiration date. So any option that is determined to be out of the money is valued at zero. There's no partial or anything. It's just going to be a value of zero. Any option that is determined to be in the money at expiration will be exercised. And exercising the option typically leads to a stock transaction unless you're trading an option that is cash settled, meaning no shares are exchanged at expiration, only the cash difference between where the stock closed and your strike. So if you own an in-the-money call option, you will buy 100 shares of stock priced at the strike price. This typically means you're buying shares for less money than where the stock price is currently priced in the market. So you can lock in a profit simply by selling the shares that you receive. If you own a put that is in the money, you will sell stock at the strike price of the option. This means that you'll be selling stock at a higher price than where the stock price closed. Because in order for that put to be in the money, that means that the underlying stock is lower than the strike price that you have. So you lock in profit simply by buying the market value of the stock, which is going to be lower than where you were able to sell the stock because of the strike. Now, this might help some people understand covered calls a bit more as well. The call option that you sold is already covered by the stock you own. So if the option you sell finishes in the money, you will be required to sell the shares of stock that you own at the price of the strike of the option, which will be below the market price of the stock. When you buy or sell option spreads, the spreads still expire based on the individual options that make up the spread. So expiration is handled on a strike by strike basis. So it's not that your spread is in the money. At the end of the day, it's each option is in the money. And if you bought one and sold one, you'll be able to figure out the stock transaction or cash transaction from there. So when it comes to trading options, you definitely have to consider what will happen to each option that makes up the spread or any trade that you put on. And if you sell it, remember, a seller of the option actually has the obligation to deliver shares of stock, whereas the buyer of the option has the right to exercise if it's in the money. So that's it for a little conversation on expiration. I know sometimes it can be a little tricky if you're starting out in option trading and you really want to get a handle on what you've done and what the risks are. If you ever have questions, like I said, you can reach out to me via email. I do answer all of my email directly or personally, so that's a positive and a negative, because sometimes in a busy week I might take a while to respond, but I do ultimately respond. Feel free to reach out. You can ask your questions. I love helping people get started in options. I've been doing this for a long time, so my understanding is options are more than familiar to me. If you're starting out, then it might be a little bit tricky at first, and I definitely can help with some of the nuanced information that helped me make sense of option trading early on. Okay, well, let's get into the trade review from last week's trades. And last week's trades were set up perfectly for an upwardly trending market, meaning I sold a put and I bought a call spread. Now, of course, the markets didn't continue higher. They came off quite a bit, so roughly 5% each. So consider this foreshadowing for the trade results for our spreads. It was a rather painful week for that. But we'll start off with the covered call. And we're looking at Stitch Fix Inc., symbol S as in Sierra, F as in Foxtrot, I as in India, X as in X-ray. When we first looked at the stock, it was trading for $24.96. And we decided to buy shares of the stock and sell the June 25 call at $2.50, hoping for a maximum return of 10.18, nearly 10.2% in 2 weeks. Well, Stitch Fix stock fell $1.52 per share this week, closing the week at $23.44 per share. The call option we sold lost $2, leaving us with a net profit of 48 cents per share on this trade. Now, given that June options expire in a week, I would go ahead and close this trade and take the 48 cents profit. If you really believe in this stock fully, you can roll the strike lower by selling the June 24 call at 70 cents. I would still lean towards just taking the small profit and preparing for the next trade, because if you were to roll it lower, you're still looking at a 1 week trade, which is fairly risky. It's a lot higher risk because there's no additional time left. Now let's look at the credit spread from last week. We looked at Occidental Petroleum, symbol O as in Oscar, X as in X-ray, Y as in Yankee. The stock at the time was trading for $20.79 per share, and I looked at selling the June 20 put spread at 20 cents, which gives us a maximum possible loss of 30 cents in 2 weeks. Well, Oxy stock fell $2.29 per share. The out-of-the-money put spread we sold is now in the money. So the spread is almost at full value, which means we effectively lost roughly 30 cents per spread. That was our maximum loss from the start. So now I would typically consider selling a call spread to offset some of the risk. However, you need to sell a call spread with strikes higher than the strikes for the put option. Otherwise, you can end up in a situation where the call spread, if stock comes up, the call spread ends up in the money, so you lose money on the spread you sold, and you could still be at a loss for the put spread. So there just isn't enough time left for June expiration. So I would likely just go ahead and exit this trade or let it expire the way it is. Go ahead and lock in the loss and move on to the next trade. And finally, we're looking at the debit spread that we put on. It was on Exxon Mobil, symbol XOM, X as in X-ray, O as in Oscar, M as in Mike. We looked at buying, at the time, stock was trading for $53.08 per share. We looked at buying the June 52.5-53 call spread for 32 cents, which could give us a maximum gain of 18 cents or a 56.25% return in 2 weeks. Now, Exxon stock fell $5.91 per share this week, ending the week at $47.17 per share. The in-the-money call spread I bought is now fully out of the money. In fact, the call spread is essentially worthless at this point. The good thing is we can never lose more than the spread value of a trade. So you have the option of either letting this trade expire worthless, or you can sell out of it for a penny right now, which is quite humbling, I must say. I'm a fan of selling another call spread to lay off some of the risk. The June 48 half call spread can actually be sold for 12 cents. This would lower your loss of premium, lower your total loss on the trade from 18 cents. From the 32 cents we paid for the spread, would lower it down to 20 cents. However, this would be an additional trade. So if you sell a 50-cent spread to collect 12 cents, you can lose an additional 38 cents on the spread. And given the time until expiration, once again, I would likely just take the loss and walk away. Sometimes it's just better to walk away from these trades, take the smaller loss. Like, you guys have seen it. I'll take a loss in a week and I can turn around. I know fully that I'll make my money back. Like, I can make the money back in the July. Like, if I focus on July expiration, since June is expiring, I'll make the money back and then some. So I never worry about taking losses on some of these individual spreads. Plus, I always have a total amount that I'm willing to lose, and that's it. And I never put on so many spreads or so many trades that it's going to wipe out my whole account. So I trade quite differently with a six-figure, seven-figure account than I would with, say, a $10,000 account. So keep that in mind when you're doing these trades. And if you're learning, it never hurts to just put on one spread. I mean, with this debit spread, this Exxon trade, literally it was you paid $32 to own a spread that could be worth $50 if it ended in the money. Since it went against us, we bought a spread, so the most we could actually lose is the money that we paid for the spread, which is $32. So worst comes to worst, I lost $32 on that spread, right? And that's the way to approach option trading initially. When you start getting into into bigger sizes, bigger account sizes and whatnot, and you're putting on larger trades, if you have done a 100 lot, you'd be losing $3,200. So it certainly stings more, but fundamentally it's the same thing. And so it's just a matter of understanding risk and sizing your trades appropriately. So let's get into the new trades this week. Like I mentioned earlier, June expiration will be this upcoming Friday, June the 19th. So all of our new trades are in July expiration month. We're going to start off with the covered call, looking at Plug Power Inc., symbol PLUJ, P as in Papa, L as in Lima, U as in Uniform, G as in Golf. The stock ended the week at $5.06 per share. We're looking at buying that stock and selling the July 5.5 call at 41 cents, which could give us a maximum return of 16.8% in 5 weeks. Now, you enter this trade by buying PLUG stock for $5.06 per share and selling the July 5.5 call at 41 cents. This trade makes the most money if stock prices finish above $5.50 per share, and the break-even price is $4.65 per share. The stock purchase in real terms will require $506, and you will collect $41 for selling the option. Now, our next trade is going to be a credit spread. We're looking at the triple Qs, the Invesco QQQ Trust, symbol Q as in Quebec, Q as in Quebec, Q as in Quebec. Stock ended the week at $235.88 per share. I'm looking at just selling the July 243 call spread at 37 cents, which can give us a maximum possible loss of 63 cents per spread. Now, you enter this trade by selling the July 242 call at $5.25 and concurrently buying the July 243 call for $4.88. This is a credit spread because we are selling the spread, and this trade makes the most money if stock prices finish below $242 per share. The break-even price on this trade is $242.37. In real terms, you would receive $37 per spread you sell and have $63 per spread at risk. And then our final trade on the week is a debit spread. We're looking at Bank of America, which has been one of my favorites for a while. Symbol B as in Bravo, A as in Alpha, C as in Charlie. The stock ended the week at $24.78, and I'm looking at buying the July 26-25 put spread for 59 cents, which can give us a maximum gain of 41 cents or almost 70% return on your capital in 5 weeks. Now you enter this trade by buying the July 26 put for $2.56 and concurrently selling the July 25 put at $1.97. This is a debit spread because we are buying the spread, and this trade makes the most money if stock prices finish below $25 per share. The break-even price on this is $25.41. In real terms, you will pay $59 to enter this spread, and your maximum gain is $41 per spread. And of course, that's for one lot. If you decide to do 10 of them, you'll pay $590, and your maximum gain is going to be $410. So you simply multiply the price by the volume that you're looking to trade. So that's it for this week's show. It's a little bit shorter, mostly because we didn't have any real adjustments on the trade review. But I'm looking forward to this upcoming week, both in the markets and in the trading. We're seeing some interesting markets happen right now, and I think we're getting the results, especially with the Fed announcement this past week. We're getting the results of the global kind of the shutdown that we experienced economically, and we'll see if the market is able to bounce back or if it truly does continue to fall lower. So if it falls lower, we did the right thing. We bought a put spread, sold a call spread. Make sure that you size your trades based on the amount of risk you're willing to take on. If you're uncertain on where this market is going, do a couple of one-lot spreads. If you really have some conviction, go ahead and size up. So that's it. I hope you guys have a great weekend, and as always, happy trading. Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer: there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.